Asha. Hi, everyone. It's nice to see you virtually, at least on the screen. I know it's been a long 10, 12 months now almost with the pandemic, so I hope you're all hanging in there. It's an honor for me to be able to speak to each of you. I thought today what I would share is my experience that I went through when I worked at Waypoint Homes. As Asha mentioned, I was CFO of a company called Waypoint Homes for about 3.5 years. And I believe Asha shared with you a case study that was done by the Stanford MBA program on Waypoint Homes. And I assume many of you may not have had a chance to read it. So what I thought I'd do is maybe just give you some background and a backdrop on what that case study was all about, just to set up sort of the presentation before I go into the IPO and the M&A that we went through. Does that sound good? So maybe just to get some interaction in the chat box, if you are currently renting a single family rental house right now, just say yes or put your name in there or something like that. I just want to get a feel as to how many people on here actually not own a house, but renting a single family house, not an apartment, but a single family. For just a few of you. Okay. Great. So the case study is on Waypoint Homes, and some of you who are old enough may remember that back in 2007, 2008, there was a financial crisis and millions of homes were in foreclosure or were just outright abandoned by people who couldn't pay the mortgages anymore. So home prices declined significantly, losing about 65% of their value from their peak during that period. In 2009, two of the co-founders of Waypoint Homes, one is Doug Bryan, who attended Cal. He was the place kicker at Cal, and then he got recruited by the San Francisco 49ers. And he was the place kicker for the Niners for, I want to say 9 to 12 years, something like that. And in his rookie year, he actually got his first Super Bowl ring. So that was sort of exciting. So he won his Super Bowl in his rookie year, and he, together with Colin Wheel, who's a tech entrepreneurial and an angel investor, basically co-founded Waypoint. The way they started was they began using their own personal money to buy single family houses back in 2008, 2009. So they put in about $1 million of their own money, and they bought homes in the suburbs of Vallejo, Fairfield, Antioch. That's where they started buying. And remember, the home prices were at a significant decline at that time. So they were able to buy homes at $84,000 on average for a single family house, which if you think about that, that's pretty low, pretty crazy, right? So they were able to buy about 26 homes, and they thought, wow, this is actually a pretty good investment, because what they did was after they purchased it, they would put in about $15,000 to $17,000 to renovate the house, maybe upgrade the kitchen and the bath and so forth. And they were able to then rent it out for about $1,600 a month. So if you do the math of $1,600 a month times 12, get the annual rate, divide by the purchase price of $84,000 plus, $15,000 of renovation, that return is 20%. And that was unheard of back then for residential housing to have a 20% return. So as they were buying and accumulating these homes, they thought, wow, this could become a business. What they found out was that home ownership back then was only about mid 60s, 64, 65% of people actually owning their house. But the remaining 1/3 of the house inventory were rentals, right? And so a JP Morgan study estimated that the value of single family rental market was $1.5 trillion. $1.5 trillion. So it was massive. And this was back in 2012. Double the size of multifamily rentals, right? So if you think about apartments, the single family rental total market was double that. And then single family rentals were mainly owned by mom and pops. So some families or some mom and pops may own 2, 3, maybe 5 single family rentals that they would run themselves and manage themselves. But there were no institutional operators at all in this sector, in this real estate sector. Also, there was nobody operating at a scale either. So if you think about mom and pop, you handle it one by one versus an operating platform. So in 2009, Doug and Colin hired a CTO, and they brought in a person that was able to really build a technology platform. We called it Compass, to be able to buy and lease and renovate and track all of the homes pretty efficiently and automated. And so they were building an operating platform that could be scalable. So by 2009 to 2011, between those years, Waypoint was able to raise 7 friends and family funds and institutional investment funds, right? So 7 of them, ranging anywhere between 6.4 million per fund to 25 million at the peak. Their IRR grew to 22 to 30% over that time, which was unheard of again for most of the residential REITs in the industry. And REITs, if you're not familiar, stands for Real Estate Investment Trusts. It's a way for people to invest in real estate similar to mutual funds. And Waypoint's tagline, let me share my screen so you can see this, hopefully. All right, are you able to see this reinventing renting?
Yes, we are.
Yes.
Thank you. Okay, so this was Waypoint's tagline and mission. They wanted to reinvent renting through quality homes, great service, rewarding leases on a foundation of respect for their residents. And this was sort of the logo that we used in all of our decks. In 2012, they knew that they needed more equity to continue the growth and continue buying in several markets. And so they wanted to set up to go public back in 2012. They went through 3 CFOs in 1 year. And I think the CFOs were not able to get the company ready. And they brought me in early 2013, January of 2013, with the goal of being IPO ready. And I had worked for a global public industrial REIT for 18 years. Prologis is the name of the company now. So I had gone through one IPO with that company. I had set up all of the financial controls under SOX 404 requirements for SEC. We went through a merger there, so I was in charge of all merger integration processes. When I had left Prologis, I was the chief global process officer. So basically looking at ways to automate and make things more efficient for the company. So at the end of 2012, as I mentioned, they wanted to go public. And there was one other single family rental company called Silver Bay that was able to go public in December. But they were smaller. They only owned about 3,000 homes, and they were able to raise about 228 million at the time of their IPO. SFR, or single family rentals, became really popular starting in 2012. So many of you may have heard of Blackstone. They're the biggest private equity firm, and they started buying single family rental homes also in mid 2012 and started amassing some of the homes. But again, they didn't have the operating platform. They didn't have the technology in place. And what ended up happening was a lot of their homes stayed vacant. They didn't renovate it and they didn't lease it out. They just wanted to buy up all the inventory while prices were cheap. So when I joined in January of 2013, Waypoint had about 2.5 billion of assets under management and about 16,000 homes. They had homes in the Bay Area, Southern California, Chicago, South Florida, Atlanta, Dallas, Houston, Phoenix. So all throughout key markets in the US. And because Waypoint was sort of the pioneers of this new single family rental real estate sector, we wanted to go out, hit the road, tell the story, and be able to raise capital. Okay. So that gets us to me joining Waypoint and the IPO and the merger story. Any questions right now, or should we wait till the end, Asha?
This is quite an amazing story. So normally we wait to the end, but if anybody has a couple of quick questions, I'm going to ask the management 624 students to jump in if you have something you want to ask right now that's relevant to what's been said. Okay, I'm going to say Nina continue because it looks like people are listening. Let's just keep them entertained here.
No problem. All right, so what I will share next is the presentation. So I'm going to keep this high level. Hopefully you can see the deck that says Waypoint Homes Roadshow presentation, right? During my 3.5 years, we went through 1 IPO and 2 M&A, and then 1 M&A transaction shortly after I left. So if you think about this single family rental sector, it started out small, but it got really big through M&A transactions because the companies wanted to scale. So this is just an example of what we did during our roadshow. So when I joined, I had 6 months basically to clean up the books, get us ready to go public, make sure all of the financial controls under SOX 404 requirements for the SEC were in place, hire the right team to be ready once we are public to do all the quarterly filings and the earnings release and the analyst calls that happens every quarter and the forecast and guidance, right? And so within those 6 months, I basically didn't sleep. I worked a lot. And by June of 2013, we hit the road. It's called a roadshow, where you go and present what it is that you are trying to sell to the investors, your background about the company. So these are a few slides from that testing the water roadshow. This was not the official roadshow. What we wanted to do was go out and test the waters with a few investors in New York and be able to say, yes, there's an interest and we should launch. So in June, we went out with some of the slides from the deck. And this is an example of what the first slide usually looks like. We were represented by 3 investment bankers, Citi, Jefferies, and Deutsche Bank. And then normally you'll put in how much you want to raise, what the anticipated price date would be, your new ticker, where you're listing, and so forth, and what you use the proceeds for. Okay, so that's just basic data around Waypoint Homes. This was our team that went out on this Testing the Waters roadshow. So we had our CEO and chairman, a COO, myself, and the chief technology officer. We talked about the total addressable market of single family rental. So if you look at this pie chart, the bigger pie chart with the blue and the silver and gold. Could someone mute? There we go. Okay. So if you look at this pie chart, you can see that the total housing inventory, of the total housing inventory, about 60% was owner occupied, about 21% was multifamily apartments, and then single family rental was about 10.5% of that slice, and then 9.5% vacant. If you then take the single family rental slice and looked at who owned it, only 1% of that slice was owned by institutional investors. Everything else, 99%, was owned by mom and pops, right? So the single family rental market that time now was $2 trillion. And there was a lot of opportunity for a company like Waypoint to be able to take a slice of that pie. And then the bottom chart just showed the historical ownership rate. So you can see over the years, the ownership rate actually declined and more people are renting. This slide, we try to portray the growth of Waypoint and the pace at which the homes were being purchased every year and the number of employees that were in place during the time when we tried to go public here in June of 2019. What happened after we did the testing of the waters, actually, we were still in New York at that time, and I think Bernanke spoke that afternoon, and the market started to tank. And so we said, this is not a good time for us to go out and go public on our own. At that same time, there was a company called Starwood Capital Group. If some of you know, like the Starwood hotels back then that owns Westin and some of the Starwood hotels that are now, I think, merged with Marriott. Barry Sternlicht, who started Starwood, he had a subsidiary called Starwood Property Group that was also buying single family rental homes. They were buying from the east of the US and we were buying from the west of the US. And we had the operating platform, but we didn't have the capital. They had the capital, but they didn't have the operating platform. So while we were in New York, we met with Barry Sternlicht and his Starwood team, and we basically talked about the goal of taking the company public, what they were looking for, what we were looking for, and it was sort of a natural marriage to merge the two companies. So the next slides that I will share with you is basically Waypoint merging with Starwood and then trying to go public through the Starwood entity that was already formed. And so now you'll see Starwood Waypoint Residential Trust. Okay, and then when we went and did the roadshow, these were some of the slides that we had, we used to pitch to investors and analysts. But basically, the ticker now became SWAY, Starwood Waypoint Residential Trust, instead of just Waypoint. The spin size was about $1 billion. We were going to go out at about $26.47. And at that time, there was about 6,700 homes, as well as a non-performing loan portfolio that Starwood had under their ownership. And so we took that public as well. And basically by January of 2014, we were able to spin off and go public as the new SWAY entity. This is sort of the structure that was formed. I won't go through all the detail, but you can see on the far left, the blue rectangle where it says Starwood Waypoint Residential Trust, SWAY REIT, that was the public entity. And under that, you have operating companies and so forth. It was an externally managed company. So we formed a management company called SWAY Management that then charged the REIT a fee to manage it. And Waypoint Homes still had some separate accounts that we kept, which we called Legacy Fund, where we didn't merge it in with the public company. So we continue to manage that separately. So this slide basically shows you the inventory of the homes that, again, grew through the years with Waypoint in the blue bars on the bottom. And then the maroon ones in the far right, where you see Q4, where it says initiated the integration of Starwood portfolio. We were able to take a seed fund that we had formed to go public on our own under Waypoint, this 3,400 homes here, combined with Starwood's 1,600 homes. And we took that portfolio public. Okay. So by then the average home cost was about $149,000, and the average monthly rent that we were able to get from residents was about $1,500 a month. All right, so that was one merger. And then a couple of years later, we wanted to continue to scale and grow and be a little more efficient. And Colony American Homes was another company private company at that time that wanted to go into the single family rental sector. And we started talking about merging with them. So the two portfolio between Starwood Waypoint on the bottom left and Colony American Homes on the bottom right, you can see all the stats there, but Colony had about 18,000 homes. Their average rent was $1,500 roughly. And then Starwood Waypoint, we had about 13,000 homes at $1,500 as well. And you can see all the occupancy and so forth. So we combined the two companies and basically formed Colony Starwood Homes. The names changed over time, but we started with Colony Starwood Homes. And during this time, we were able to grow it to 30,000 homes under the combined portfolio. So we saved 50 million in synergies overall, right? If you think about headcount, public company costs, legal costs, all of that, you don't need two companies to sort of run the same platform. And if you merge it, you can save a lot of bottom line dollars. And the portfolio, this map shows in the blue was where Waypoint had properties. In the orange was where Colony had their properties. And then all of the slanted blue and gold were markets where we both overlapped. So we had a lot of synergy in terms of having management teams in the same locations. But these were all of the areas where we had our operating platform and in the market teams. Okay, I left in 2016, and in 2017, Colony and Starwood then merged again with Invitation Homes. Again, it's for scale, it's for synergy, cost savings. And Invitation Homes, if you remember, I mentioned Blackstone at the beginning. Back in 2012, they were also buying a lot of single family homes, but not operating it. So they owned a huge portfolio, but maybe by 2017, they had an operating platform, but they did need a better operator to help manage those homes. So they merged with Starwood Waypoint, and it became 82,000 homes portfolio. So you can see here all the markets that were combined, a lot in Southern California and in Florida, Tampa, all over various markets in the US. Okay. And then this just recaps a summary of what I just walked through. The Waypoint Homes founded in 2009. The case study I gave you background on was done in Q4 of 12. We did the testing of the Waters Roadshow in the summer of 13. We merged in Q4 of 13. We went public in Q1 of 14. We merged with Colony in Q1 of 16. The name changed back to Starwood Waypoint in Q2 17, and then the merger again with Invitation Homes. And now Invitation Homes is the active company trading under IVH as the ticker symbol on the New York Stock Exchange. So that gives you an overview. I just had some slides on the REITs, but I will probably skip that, Asha. And since it's almost 4:30, I'll end it there and see if anyone has questions.